Let us see what is the definition of an option. So, in simple terms, option trading gives the right to buy or sell something at a specific price on a specific date. So, here you see there are three important things. One, the right to buy or sell something. Okay. Number two, on a specific date. And number three, at a specific price. So, these three things is what defines an option trade. So to understand this, let's take a small example. See, as you see on the screen here, there is a pen. Let's assume that the price of the pen is currently say rupees 100. Okay, there is a buyer who is interested to buy the pen, and there is a seller who is interested to even sell the pen. However, we are not going to do the regular transaction of buying the pen here. We are going to do options trading. So what I mean by options trading? By options trading, what I meant is the buyer wants to buy this pen next month, say at rupees 110. Okay, that is the deal with which he's going to approach the seller. So, in order to lock the price of the pen, which is currently trading at 100, but the buyer who wants to buy this at 110 next month, he is going to give the seller a small token amount of say rupees 2. So the seller receives this rupees 2 and keeps it with himself. If the price of the pen goes beyond 110, the seller is obligated to sell this pen to the buyer at 110 itself. So for example, if next month the price of this pen drastically goes up to say 200, okay, but still the contract says that the buyer will be able to buy the same pen at rupees 110 because he has paid the advance amount of say rupees 2 to the seller. So this contract is what the buyer's contract which he can exercise in order to buy this pen at a cheaper rate. But what happens if the price of the pen goes below, like say 100, or even if it stays below 110? Then what does the buyer do? He don't need to exercise this right. So all that we are trying to understand here is the buyer has a right to buy something, in this case a pen, at a specific price, say 110, at a specific date, which is end of next month. And for all this transaction, the buyer is paying the seller a token amount. The seller will only get the profit if the price of the pen stays below 110, and the buyer will get profit if the price of the pen goes beyond 110, so that he can buy the pen at 110 itself, because he has a contract. So this gives you a basic idea of what an option is. Let us see the opposite of this as well. We have just spoken about buying something at a specific price at a specific date. But as the definition of option trade is, we can also sell something at a specific price on a specific date. So how does that happen? So let's take the same example of the pen here. And the buyer thinks that the prices of the pens are going to go down drastically down. So he contacts the seller and he buys the contract with the seller, saying that he is interested to sell the pen for rupees 90 next month. The idea behind the buyer buying this kind of a contract is he is expecting the prices of the pen to fall down drastically. Say, suppose like it might go down to 50 rupees. So, keeping that in mind, the buyer wanted to lock the price of the pen at 90 rupees with the seller. So he pays a token amount or an advance, we can call it, of rupees 3 to the seller. So the seller keeps this 3 rupees. When does the seller get the benefit? If the price of the pen stays above 90. But if the price of the pen goes below 90, say it reaches 70 or 65, then what happens? The buyer who has the contract to sell this pen at rupees 90 will be coming into picture and will try to sell this pen at a higher price, even though the product is available in the market at 65 rupees or 60 rupees next month. So this is what option trading is all about at a basic high level view. In order for you to understand what option trading is, we have taken a small, this is not a practical example, but to understand how option trading works, this is the closest example that I can give.